Hey, good morning, everybody. Hope your Saturday's off to a good start. Welcome to another edition of Coffee with Kirk. It's going to be a little bit of a short one today for a couple reasons. One, I had a little video, like a 10, 15-minute video, and having tech issues with it this morning, so wasn't really able to get it functioning within my webinar software. And then the other thing is I'm actually out in Colorado right now. And about 20 years ago, one of my closest Coast Guard buddies, he died in a mountain climbing accident. So it's sort of the 20-year anniversary. So a whole bunch of us have gotten together, and we're gonna climb, maybe being idiots, but we're gonna climb up a 14,000 foot mountain tomorrow. So I came out here this week and spent a little bit of time out in Colorado. So we're kind of doing it to honor him. We're doing a very easy climb. It's basically just a trailhead that goes up. He did a little bit more of a complicated climb, and I think obviously we don't know what actually happened to him, but we think that weather came in when he was on the top of the mountain, and he tried to get down the mountain quickly, and was taking kind of a faster path down, but it was loose rock, and it just kind of, his feet went out from underneath him. Sort of a little avalanche happened, and he literally went over like a 2,000 foot drop or something like that. I don't know exactly, but anyway, so this will be short today. I didn't have a ton of time to put things together, but I just really wanted to kind of talk about some of the moves I'm slowly making in your portfolios. You probably see some trades confirmations. You're going to see some more this week. But let me jump into my slides. But I think we're finally getting to the point where I feel like I know what's happening here in the economy. And I talked about this last time, that what I was kind of seeing this whole year was sort of a yin and yang. As soon as I thought I had the right idea if there was an inflationary environment, or if we were actually, heading into some sort of deflation, like I think, oh, okay, this is clearly going to be inflation. And then all of a sudden the numbers would change. Everything would start heading the other way. I'm like, oh, maybe it's deflation, and then switch back to inflation. But I'm pretty sure, as I talked about last time, it looks like it's deflationary. So deflationary is basically going to be the economic activity is slowing. So GDP is slowing. It doesn't necessarily mean a recession, although, I'm kind of thinking we're going to have that, but it doesn't mean that's going to happen. But it also means that inflation is going to moderate too. So we could actually see a little bit of relief, at the gas pump, at the grocery store. It's not going to go back to where it was a few years ago, but at least if it starts to slow or come back a little bit, every little bit helps. And the reason I think I'm pretty strong on this deflationary situation is looking at a lot of different asset classes that kind of tell you the story. They're all pointing to deflation right now. So this is just a chart that you're looking at here of oil. So this is the energy sector. So this is essentially, the 40 largest energy providers in the United States. And you can kind of see this is year to date, and you sort of see early in the year, very early, the beginning of the year, oil was dropping. Thought, okay, we're heading into deflation. And then we had about 4 months where oil went up substantially, and then it's been down and up and down and up. So it's been hard to tell. But from the peak back in April, you can see we're down quite a bit in oil. So that's kind of telling me, oil is still the lifeblood of the economy. And if the economy is booming around the world, you're going to see oil prices go up because there's just more demand for it. And it's not just oil itself that's been this way. It's commodities in general. So this is a ETF that we do use, and we basically sold out of, but it invests in the 24 most liquid commodities. Oil is one of them. It is one part of the component here, but it's got 23 other commodities that it uses. So again, you can kind of see beginning of the year look like deflation, middle of the year look like, oh, okay, it's definitely inflation. But at this point now, it's again looking like we're heading to a deflationary, slowing environment. And then bonds. Bonds also tell the story too. So when bond yields are going down, so if you go from 5% to 4%, what the bond market's basically saying is one of two things. Either they're expecting inflation's going to moderate, which that could be what's happening here, or it's saying that they're expecting lower economic activity. If you have less demand for mortgages, for business loans, for auto loans, RV loans, all of that, then interest rates are going to come down if there's not as much demand. If the economy's booming and there's a large demand for it, typically you're going to see interest rates go up for that. And usually what you see with bonds is it's got a yin and yang with the stock market. So if bonds are doing well, stocks aren't, and that's kind of what we're seeing here. So as you look at this chart, this is the 10-year Treasury, the 7 to 10-year ETF. And now bond yields are different than bond prices. So what this is looking at, you can see, if you look at the far right, it's gaining in value. So that what that means is that interest rates are going down. So the bond prices themselves are going up. So this chart, when you look at it, even though, and again, this confuses investors a lot, but if the bond prices are going up, that means yields are coming down. So that's what we're seeing right now. So again, bond yields going down is typically a deflationary event, whereas if the prices are going up, that's also deflationary. So it's a little tricky thing that gets folks. And as you'll see, we're actually starting to slowly add into this holding. Another one that we're adding in slowly is this is just a little bit even longer dated treasury. So this is the 20-year plus ETF that has treasuries in it. And here again, you can kind of see that yields are coming down, bond prices are going up. So this ETF that holds these bonds, they're going up in value. So just looking at seeing some more deflation in that. So both of these, the IEF and this TLT, we're going to be adding a little bit more to it. We have one holding right now that is basically, for the most part, it's a bond holding. 95% of the assets are in T-bills, but the other 5% are invested in the dollar. And the dollar is getting weaker, so I'm moving from the holding that has the dollar. The ticker, if you want to know, is USDU. We're moving from that to the 10-year and 20-year treasury. So starting to step out a little bit in maturities. We've been really, really short in our bond exposure to mostly treasury bills for the past couple of years, only because treasury bills were yielding more, and they still are yielding more than longer dated. But I think if we do start to go into a more deflationary or even recessionary environment, then the 10-year and 20-year treasuries are going to see a continued increase in price. So it makes a little bit of sense to start adding some longer dated bonds in there. Adding to kind of the sort of deflationary slowing economy argument, the unemployment came out yesterday. Markets did not like it. You still had 142,000 jobs created for the month, but as we've talked about, they've been revising these down considerably, and they revised down last month's as well, which was already a bad number. So this 142 is probably going to come down even more, I would expect. But they were clearly expecting more. I think the number that most people were thinking we'd get would be at least 165,000, and we didn't get that. So it's clearly starting to show that unemployment is starting to slow down, which is deflationary. Some other little things that were tidbits that came around from around the world. So Germany has, their industrial production, and Germany's still a very heavy industrial economy. It dropped 5% year over year. And if you look at the total amount of industrial production, it's now 10% below the levels before it was at COVID. So Germany hasn't even gotten back to COVID levels yet. So they're definitely heading into a deflationary environment, a big European economy there. And then South Korea is also, really a fully exporting nation. I mean, you can look and see the demand for products from South Korea. So if they aren't exporting as much, then you know that there's definitely a slowdown in the world. And they came out just talking about how their semiconductor production is now at a 5-year low. South Korea is probably the second largest semiconductor producer behind Taiwan. So they came out and said things are really looking bad there for semiconductors. So where do we go? Where am I going with all this? So you want to go into sectors that are going to do pretty well when you have a deflationary, slowing economy, slowing inflation environment. So I've already mentioned that longer dated treasuries are a great place to be in that. And we're starting to see that that's panning out. Another, as far as the stock side of it, you want to be in really 3 sectors. I'll talk about all of them, but some consumer staples, so things that people are going to buy no matter what the environment is. You want to be in utilities because, again, you're going to turn your lights on. You're going to use utilities even if the economy's bad. And then finally, healthcare is always a good one to go into when things are slowing because there's always, again, going to be demand for healthcare. Now, with consumer staples, I'm not buying the general ETF that invests in, dozens of consumer staple stocks. I'm actually going in and picking out a few. And I'm trying to find some stocks that have very low price to earnings. And again, we've talked about this a lot. You just take the price of the stock, divide it by its earnings per share, and that gives you a figure. And obviously, the lower the price to earnings, the better for you as an investor. So the first one's Altria. I'm adding this. I know some people don't like this. It is a cigarette company, but it's been around forever. And for right now, when you look at it, it's got a 7.25% dividend yield, and it's trading at 9 times earnings. So it's just really cheap. And if you look at the chart, you can start to see the market is finally starting to reward this company. It's been about 40 to 45 for years now. It's just floated in between those 2 figures, and now it's actually starting to break out a little bit. And I expect with this kind of value in there, there's going to be more investors run to it. And the other thing is yields start to drop as we go from 5 to 4%, or maybe even lower. If you're paying 7.25% on a dividend, that's going to attract a lot of investors because now you can basically get a much higher yield from something like Altria than you can from a bond. I've also mentioned this before. Kroger, the largest grocer in the United States, clearly a much lower dividend yield at 2.4% and an 18 price to earnings. So it's not rock bottom cheap, but still a pretty compelling valuation when you look at the rest of the market that's trading well above a price to earnings of 25. And again, people are still going to go to the grocery store. That's one area they're going to go. So adding a little bit here to Kroger. Another one that we're adding to is Kimberly-Clark. And what does Kimberly-Clark do? They make toilet paper. And trust me, toilet paper is one area that people are going to continue to use. So compelling valuations of 3.3% dividend yield and under a 20 price to earnings. So and you can see the market's finally starting to kind of reward this company. If I went back and showed you a 5-year chart, it's pretty flat. It's finally starting to see some movement up. Another one kind of along the lines of the Kroger, but General Mills, it's another company that people are going to continue to buy this stuff. It's got over a 3% dividend yield and only a 17 price to earnings. And as you look at the chart, you can start to see that money is slowly starting to move into this stock. The market's starting to recognize the rotation, the deflation rotation that's happening. And then finally, another one that I've had my eye on for a while is just AT&T. So you're talking about a 5.3% dividend yield, and you got a really low price to earnings at 12. So really strong, compelling valuations in these consumer staple stocks. So we're adding those slowly. And of course, I mentioned that utilities is another area that we're adding into. Utilities has also done pretty well this year. We've owned it for most of the year, but it's done pretty well the whole year, mostly because it was kind of a backdoor play on the whole AI, because if AI does become a really big part of the financial landscape, if it becomes a big part of our economy, it's going to take a lot of power to be able to generate AI. So you could say that there's a long-term play here. It's just the fact that there's going to be more energy demand. But I think what's really driving it right now is just the fact that you're getting over 3% dividend yield in something that's very reliable, very steady cash flows. So we've had this for a while, and we're going to continue to add to it a little bit. And of course, I mentioned also healthcare. Healthcare is a sector that people are always going to be using. So this healthcare ETF essentially is not only just the providers of medical care for you, but also some pharmaceutical, so drugs and actual equipment and services. So I think those areas are probably going to do pretty well on the stock side, just if we continue to see a slowing economy. And and of course with the elections going on, and what a crazy election year it's been so far, having people are going to get a little bit nervous here. So you're probably going to see people leave some growth areas for a little bit more value, just for protection. So again, I apologize. This one's a little bit short today. That's probably pretty good. I still stretched it out to 20 minutes, but I didn't get the video together, and then I just didn't have as much time to put a lot of slides together. I just wanted to let you know kind of what I'm doing. And like I've always got to tell you, if you're not a client where I'm actually managing your money, please do not take this as financial advice. Don't go out and make any big decisions unless you talk to your financial planner. I know a few people around here like that, but just wanted to kind of let you know a little bit about where I'm seeing things going and what I'm doing for clients' portfolios that I'm actually managing. So let me see. I don't know if we have any questions or not. Again, a very quick session today. No questions. Okay. So we have some pretty beautiful weather out here in Colorado, and we're heading out to, if you want to know what mountain we're going up, it's called Handies, Handies, I think it is. So you can go and see, it's over in the San Juan mountain range here in Colorado. So you can check that out, look at some photos, and that's where we'll be early tomorrow morning. So hope everybody has a great weekend, and we'll talk to you all soon.